Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it looks like we are going to end the week on a pretty good note. Some very positive movement on Thursday. We will take it. It's actually been a pretty good week. A couple no real movement days and then a pretty positive Thursday. Let's hope it continues into the weekend. That's what we're hoping for. But welcome, everyone, to my favorite edition of Wilmington Mortgage. It is the Friday edition, and I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina. We break down the top stories impacting mortgage rates every single weekday, unless, of course, I just take a month off for, no real reason. But we're here now, so it's all good. So, yeah, it was a pretty good day for rates. The 10-year closed out Thursday down just under 5 basis points. And then we saw the 30-year fixed, which is funny because we had a 30-year Treasury auction, which was not so great. But the 30-year fixed, according to Mortgage News Daily, was down 5 basis points. Yeah, that's right, 5 basis points. And now at almost the lowest level in about a month. So, as I always say, the 10-year and the 30-year, move kind of in the same direction, just not at the same time. So sometimes we see bigger moves with mortgage rates. Sometimes we see bigger moves with the 10-year and vice versa. And so it's, it is what it is. So why are rates falling? Well, it's important to understand the bond market and sort of a lot of the confusion about the Fed, that when the Fed makes a decision, that's when rates move. And we know that's not what happens. What happens is the bond market is sort of predicting what the Fed is going to do, and that's why sort of forward guidance has become such a huge aspect, and there's a lot of freaking out about Kevin Warsh being Fed chair and pulling back on that forward guidance, because the bond market is sort of pricing in what the Fed is going to do. So if the Fed's going to cut, you're going to see yields in the bond market fall ahead of the cut. And vice versa. Like if they know there's going to be a hike, then the bond market yields will rise because of that. And so because what's happening right now is the bond market had priced in a Fed hike in September. So, we had was it August? It was August, right? It was the beginning of August. The Fed had a meeting. My days and weeks all combined. And they did not, we thought maybe there's a really kind of outside chance, not zero. I think going into the market, the CME Fed Watch tool had like a 30% chance the Fed was going to hike rates. And so there was the thinking that, with inflation and some of these numbers that are coming in, concern about what's happening in the Middle East, that they could possibly hike rates. And then they didn't. And then all of a sudden the markets almost immediately began pricing in a rate hike in September. And I think at one point it was like 70% of traders were thinking it. And then we got a really bad jobs report last week. And then we got a CPI report on Wednesday. And all of these were signs that, maybe the Fed doesn't have to hike rates. We have a weakening labor market and inflation is coming down. Now, it's not where they want it, but it's coming down. And so maybe they can kind of wait it out and see where prices and everything are going. So what's happening is we're seeing it with, once again, the CME Fed Watch tool, where at the beginning of this week, it was a 60% or some chance the Fed was going to hike rates. And now it's more likely they're going to hold rates. It's like a coin flip, but I think it's like 55-45 they're going to hold. And so the markets are now beginning to price in maybe there won't be a cut. So they're kind of pulling back from that initial move upward. And so that's why we're seeing rates falling. And a lot of it is because of inflation data. So we got a CPI report that was better than expected. I mean, actually, it was almost exactly as expected. And because it wasn't worse, and because of the bad jobs report, it was like, all right, maybe we can hold. But then we got PPI. So this is wholesale prices, producer price index. And it was a little surprising to the upside. And by upside, I mean good, which would be downside for rates. A little confusing here. So they were expecting after last month, like with CPI, we did see a downward move, but they were expecting that to somewhat correct, and it didn't. In fact, the producer price index was flat in July, which was up from the 0.3% decline that we saw in June, but was the second best month in the last 11 months, so almost the second best reading in a year. And economists were expecting a 0.2% rise, so better than expected. Annual producer inflation slowed considerably, falling to 4.7% from 5.5%, so still extremely high. 4.7, target rate's 2, but a big drop from 5.5. That was the lowest rate since March and was better than the 4.9% economists were expecting. And then we got into core, always an important factor. That did rise, just kind of like with CPI. We saw bigger movement in core. Core prices were up 0.2%, which was actually better than June, which was 0.4%. And it beat expectations of a 0.3% gain. And it was the second smallest monthly increase in nearly a year. So very similar to the top line number. Core producer inflation slowed to 4.2% annually, which was down from 4.7% and the lowest level since March. So a good, very good PPI report, which is almost sometimes better than a CPI report because PPI front runs CPI. So to see bigger moves like that are going to be a welcome sign by the market. And it was. We got more movement with the PPI than we did with the CPI report. So this was a good sign. So we have concerns about the labor market. And there was also a great piece today in the Journal by Greg Ip, basically saying the jobless economic boom. And it was pointing out, once again, this goes back to Jerome Powell when he was Fed chair, and he kind of made that comment about the low hire, low fire environment. And we still seem to be in that, where we're not seeing crazy amount of hiring, which has been somewhat detrimental for, college graduates and others getting into the job market. However, we do have jobless claims. Let's talk about that for a second. But the point is that we're not seeing a horrible deterioration in the jobs market. In fact, I was watching Bloomberg, and they had a guy on who was talking about the July report and how the July report, because of summer and school starting, and it's always been sort of a bad report. It's kind of like the beginning of the year when you always see a spike in CPI because at the beginning of the year, a lot of companies raise prices and everything else happened at the start of the year. And so it gives this sort of distortion that there's, this big spike that's happening when really it's just sort of this thing that happens at the beginning of the year. And it's sort of what happens with the job market in July. It's kind of a very shaky time where, towards the end of July, maybe you're seeing some people who are, leaving summer jobs or whatever, seasonal jobs or whatever it may be. But July is just normally a bad month. But it was still a bad report. And you have that on top of, still high inflation. Not great, but it's getting better. And so it's not getting to the point where the Fed should cut rates, but it's also not bad enough that the Fed should be hiking rates. And so a lot of this data, really what it's doing is it's allowing the Fed to kind of kick the can, which is kind of a bad phrase, because usually it's always with regards to like Washington when they don't want to fix a problem, they can kick the can down the road. This isn't about them not fixing a problem. It's about them waiting to see exactly what the problem is and giving them a little more runway to say, okay, we know definitely labor market concerns, we should cut rates, or we can hold, or we're really concerned about inflation, we got to hike. And so all of this data is giving them the ability to not hike rates. And I was looking at the CME Fed Watch tool, and they're now pricing in a December. They've always kind of, December has been that month where it's like they're pricing in one this year, but it's not going to happen at the previous meeting, so it's going to happen in December. And that's kind of where we are right now. We're back to no hike until December. And so I think that's what's happening. Markets are kind of resetting to that level to where we were a few months ago. All right, speaking of jobless claims, we did get jobless claims. Those are out every week, as we know. And we did see a little bit of a jump, which is not that surprising because, jobless claims the last couple of weeks have been like 50-year lows. Initial jobless claims rose to 9,000. So 209,000 for the first week of August. Highest level since early July. So about 4-week high. Now, despite the increase, the 4-week moving average was actually unchanged at 199,000, which is the lowest level since October 2022. So the average, I think, is an important factor because it kind of takes out those spikes that sometimes we see that are caused by whatever, seasonality issues or, natural disasters that can cause hiring issues and layoffs or temporary job loss. And so the 4-week average kind of gives you a better balance of it. And the fact that we are at about a 4-year low is interesting. And then continuing claims added to that, falling to 1.78 million for the week, down from 1.8 million the previous week. And that is the lowest level since mid-May. We saw it about 2 or 3 weeks ago as well. So we're back to lowest level since mid-May. And so we're seeing very low. So it's kind of weird. We're in this weird place where we're getting these pretty good jobless reports, but we did get that awful non-farm payroll, and we did get a really bad ADP private payroll. So once again, more ammunition for the Fed to be like, we don't really know what's happening with the labor market because we're getting kind of conflicting data. So bad monthly jobs report, still not bad jobless claims. So adds to like I said, it adds to this idea that we don't really know what's happening, and the Fed should be not making a hasty decision. Hence the downward move. And then, like I said, we did have a 30-year auction, which we had a 3-year and a 10-year this week. Both were good. 30-year not. It was not. It was also, I think it was the highest level since 2000. The highest yield that we've seen for a 30-year since 2000. So the 30-year auction stopped at a high yield of 5.216%. That was above the 5.212% when issued. So we did have a tail of 0.4 basis points, which is usually not a good sign. You want a negative tail or a stop through because it means that the bidders were willing to accept a lower yield than what is out there. That's a sign of strength. So to have a tail, it's not horrible, but it's you want a negative tail or a stop through. Demand was also relatively soft, with the bid to cover ratio came in at 2.39, below the 2.42 average across this year's auctions. Indirect bidders, a category that includes foreign central banks and other international investors, took 66.8% of the auction. That was below, a pretty big drop from July's unusually strong 77.7%. That was, I think, one of the highest levels on record. So that's not exactly a good metric. In fact, this year's average is about 66.9. So indirect bidders, foreign bidders, decent. Or I should say on point with what you'd want to see. However, direct bidders were higher than the last auction because there were so many indirect bidders. Direct bidders fell 12.2% last one. This time they were 21.6%. That was below the average this year of 22.3. So we saw about what you'd want to see from indirect, a little bit of weak demand from direct bidders. And so the 10 years, obviously the bigger indicator, and it was good to see a strong 10-year, strong 3-year. To see a weak 30-year is not great, but it's not the end of the world. So I think that's why a negative 30-year auction did not have a negative impact on markets, at least not the 10-year and the 30-year, which the 30 years sort of based off the 10-year. It didn't have that big of an impact. But still, you'd like to see a stronger auction. You always want to see strong auctions. You want to see people have an appetite for U.S. debt, which we're questioning more and more often because, we're just issuing so much. Did you see the deficit? We're going to eclipse $2 trillion again, but I think we're already at 1.8. We're back to like 2021 levels. Oh, it's not good. So we are issuing a lot of debt. All right, let's hope another good day today. Retail sales are out, and then we're getting Michigan consumer sentiment is out as well. But let's keep our fingers crossed for a good day. And you guys, enjoy your Friday. Enjoy your weekend. We'll be back here Tuesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.